Good morning and welcome to this Monday, February 28th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, another week, unbelievably, almost another month. Today's the last day of February, February 28th. So this is it. And then we head into March. For me, being a golfer, I always like the transition from February to March, getting a little warmer, hopefully get back out on the course a little bit more frequently soon. So from that standpoint, it's good. From the market standpoint, not always so great. Second half of the first quarter tends to be a little bit trying anyway, February 15th to March 31st. And we got a lot of issues this year. So the market certainly has been a little bit more difficult as we move into March. Over the weekend, just more news about Russia and Ukraine. There were a lot of sanctions over the weekend that were imposed by countries around the globe. On Saturday, the U.S., European allies, and Canada all agreed to cut off key Russian banks from the interbank SWIFT messaging system. And if you're not familiar with SWIFT, it stands for Society for Worldwide Interbank Financial Telecommunication. And essentially what it means is that Russian banks will not be able to securely deal with other banks beyond their borders. So, that those things do have an impact. We'll see how much of an impact soon, but Russia ordered that its own stock market be closed today. Pre-market futures there were showing down 23%. So they just ordered it closed. I guess that's one way to avoid losses. I wish I could do that. It's my portfolio. Just tell my broker, just close it. Yeah, I don't want those. I don't want to see those losses today. I don't know. Anyway, so futures this morning here in the U.S. Down. They were down a lot when the market first opened. Yesterday, when the futures first opened. I think the NASDAQ futures were down, unless there were errors, close to 500 points. The Dow was down more than 600. We are still down considerably, but not nearly that much. Right now, we've got NASDAQ futures down about 170 points. That was probably 10 minutes ago. So a little more than 1%, maybe closer to 1.25%. And then Dow futures down over 400. Again, that was probably 10 minutes ago. So in this market, who knows where we are after 10 minutes? I mean, we could be anywhere. We could be green, but that's just kind of market environment that we have been in. Anyway, let's go ahead and get things cranking here. I do want to just take those of you who are new over to Earnings Beats, but let me get this for you here. All right, hopefully everybody has this now. First of all, welcome. If you are new to Earnings Beats, we're glad that you decided to join us this morning. For those of you who've been with us for a long, long time, thank you for your support. All the support you've given me and to Earnings Beats over the years, we really appreciate that. If you scroll down, if you don't really know a whole lot about us, what I always recommend is just going down here and filling out this name and email address, hitting the subscribe button, and joining our community of EB Digest subscribers. It's completely free. 100% free, no credit card required. You can unsubscribe at any time. And one thing I haven't really mentioned much and probably should, we do not provide your information to any third parties ever. So don't worry about your information getting out and being spammed and all that. We don't do any of that. We keep everything.
Tom, just a heads up, the website isn't showing. You're showing your desktop background.
I wondered if it was weird when I pulled it up this morning. All right, let me see if I can. Let's try this again. Is that better?
Yes.
It was so weird. I have like multiple screens that'll let me pick. And the one I was looking at, I picked. And of course, that was in a different spot than where it normally is. So who knows? I'm not a technology person, as most of you probably know. Anyhow, also I was saying was just scroll. Once you go over to earningsbeats.com, just scroll down if you're new. There's a spot where you can sign up for our Earnings Beats Digest, which is a free newsletter, name, email address, and then simply hit that subscribe button. And I was just saying it's free, so there's no credit card required. You can unsubscribe at any time. And also want to mention, because I rarely do, I probably should mention it all the time, but we do not provide your email address or name out to anyone. So it is completely safe and secure with us at Earnings Beats. We do not sell lists or anything like that. So we will keep your information private and secure. All right, let's talk a little bit about what happened at the end of last week. So we had this big rally. First of all, it started on Thursday. If you recall, that was the invasion. Everybody sold, stocks at the open. I mean, I think the Dow Jones was down 700, 800, 600. I don't know what it was, but it was down a lot. And then came rallying back all day. I mean, it was tremendous rally. I think the NASDAQ went from over 400 down to 400 up. I mean, it was crazy. But when you get volatility where it is now, this is what you have to come to expect. You don't know what you're going to wake up to. Whatever happens in the morning may not happen in the afternoon. And the craziness of these swings, I mean, it's unbelievable. The percentages, last Friday at the beginning of the day, I sent out to all of our members a special report. And I did that specifically to show you, because we had such a big rally on Thursday, and I figured we'd probably see it continue short term. And I just wanted you to see on a daily chart what other cyclical bear markets look like when things kind of get panicked and you have these big sell-offs and then these big rallies. Because it was nice. Thursday's big rally, I mean, it beat the heck out of the alternative, gapping down and then selling off all day. We could have been down to our 3,800 measurement on the S&P 500 pretty quickly at that rate. But we gapped down and we came rallying back. And so I wanted to show everyone what bear markets, cyclical bear markets look like, so that you can at least have a frame of reference as you look at today's action and keep perspective. Because I really think that's the thing most people lose in these volatile periods, is they lose perspective. And you need to know what the market tends to do. You need to focus on the more intermediate term downtrend, and not so much on what happened today or what happened this afternoon or what happened from 2 to 3, because all of that, the whipsaw action, as far as I'm concerned, is just all part of the manipulation, the coordination. I mean, call it whatever you want, but we just don't go straight down in a bear market. When you got a lot of issues, you just don't go from 4,800 to 38 or 3,500 or 3,800, whatever, in a few days. It takes periods. You go down, you bounce back, then you kind of settle down, you have another little rally, and then all of a sudden you get this big swoosh down, you have another big move down, and then guess what? You get this snapback. I call it like a rubber band rally. Market gets, you go down so fast and so far, it's like pulling that rubber band back as far as you can, and then you let go, and then the market just comes roaring back, and you're like, okay, everything's good again. Look at everybody's buying. Well, it's probably a lot more covering than anything once you start seeing some of that movement back to the upside. Anyhow, that's how cyclical bear markets move, very swiftly in both directions. The snapback rallies usually last 2 to 4 days, something like that. So we had the big rally on Thursday, reversal Friday as well. Was that it? Well, sometimes that is it. Sometimes you get that. That's about all you get, and then you go back down. Other times, we've seen some of the cyclical bear markets where you get 3 or 4 days of up and then consolidate. And then sometimes you even go back up higher a little bit and then go back down. My point is, let's watch the channels, and we're going to talk about some of those in just a little bit. Anyway, Dow Jones up 834 points, S&P up 96, NASDAQ 221. The mid caps up 72, small caps 28. I mean, you look across the board, the NASDAQ was the only one on Friday that wasn't up 2% or more. I don't know if you noticed that. That's our big aggressive growth index. I mean, these growth stocks have been killed. Certainly they're going to lead the move back to the upside, right? They did on Thursday, not so much on Friday. And we'll talk a little bit more about that in just a bit as well. Looking at the sectors, you got materials up about 3.7%, financials 3.2%, staples 3.2%, utilities 3.1%, healthcare 3.1% as well. I mean, notice something interesting about those five. We had this huge rally. Do you see technology anywhere in here, or consumer discretionary, or communication services, or even industrials? I don't see any of them. I mean, we've got materials Financials, I consider to be in the aggressive area, but that tends to move a lot with interest rates. Took a big hit on Thursday with the rates moving up, and then the rates dropped on Friday, and we had financials, or maybe I have it backwards, but financials tend to move in the direction of the 10-year Treasury yield. So we had the big drop, then we had this big rally back. But other than that, I mean, materials kind of, I view materials and energy kind of as neutral. They don't really get driven based on aggressiveness or defensiveness. They just kind of live in their own world. But anyway, when you get past these first two, these are defensive groups leading. Staples, utilities, healthcare. Are you kidding me? What this is telling me is that Wall Street just continues to pour into defensive areas as we move back up. Where's technology? Where are all these technology names on this rally? I mean, this is concerning to me. Does it guarantee us that we're going back down? No, nothing does. But it certainly gives me the signal that we're probably going back down. When I see this kind of leadership, if we were going back up, don't you think Wall Street with all their MBAs would have, be investing in the technology and consumer discretionary area, communication services? These are groups that have been leading the market down since the end of December. And in the case of communication services, it's been leading the market down since probably back in August, September. I don't remember when it topped, but it's been a while. We've been going down for quite some time. So anyway, just the makeup of everything that happened on Friday just, makes me look and pause and I don't think so. I don't think we're going up. Now, could we go up? I mean, could we rally today off of these negative futures? Sure. We got room to the upside. And a lot of times when you think you've only got so much room, you'll go up a little bit higher just to throw everybody off. If we start seeing some key breakouts, I'd be, right on that group as well. Like, hey, are we missing out on something? Have things changed? I mean, you got to continue to evaluate the market. It's not, you don't just make a call in December and then just say, hey, this is the way it's going to be, and that's it. And then be stubborn about it. I mean, you have to continually, every single day and every week, continue to look at these signals to try to get the best indication, best probability of what the market might do. But right now, I still think we go down. I don't think we've seen the low yet based on everything I'm seeing. And especially just what we're talking about here with Friday's action. Not very good. 10-year Treasury yield, let's get an update here. We are at 1.89%, back down again. So here was that big move down on Thursday when we got the rally. And of course, when we started this move to the downside, on the yield, I thought, okay, I was just thinking to myself out loud, this could help the aggressive areas, right? Because we've got lower interest rates, and anybody who's fearing the higher interest rates and lowering valuations on technology and consumer discretionary, all these different growth stocks based on higher interest rates, they should get a reprieve with lower interest rates, right? And they did. We got the gap down in the yield. And then the stock market went crazy on Thursday, including many growth stocks had huge days on Thursday. But look at the yield. The yield went right back up almost to where it started the day or where it closed the prior day. So by the end of the day, there was really no change in interest rates. And yet all these growth stocks had taken off. I mean, as far as I know, we still have inflation issues and we still have the Fed meeting in March. So these were the things that the market was really concerned about. And then Russia and Ukraine came along, and now it seems like that's all the news talks about. I'm more concerned about the U.S. stock market. I'm more concerned about what happens with inflation and interest rates, to be honest. Not that I'm not concerned about a war. I don't like wars. I don't think too many people like wars. I don't want to ever see any kind of war. And there's definitely, some, there are security interests of ours in that region, especially with crude oil. So it's not like it doesn't matter. But at the same time, the big issues that the market was dealing with have not gone away. And those are the ones I'm still focused on. And we'll see what happens, with the Russia-Ukraine conflict over the next couple of days. That's going to be driving the headlines, probably because all the other headlines are a little old and stale. They'll come back. Don't worry. We got a couple of weeks before the next CPI report comes out. They'll be back out. Trust me. But right now, they're just being stored to the side while we deal with the Russia and Ukraine conflict. But anyway, my point was when the yields were down, that was probably a good thing for growth. Well, look, yields coming back down today. This is going to be an interesting day. Are the growth stocks going to be in favor again with yields moving back down? Technically, I think they should. If they're not, then you've got to scratch your head and wonder, okay, what's going on? because I think it's the higher yields that have been killing many of these growth stocks, especially large cap lately. Large cap dealt okay with the inflation because at the time they had pricing power, and the discussion early on was that it was temporary. This was a transitory inflationary problem. And now it's evolved into oops, we made a mistake by the Fed. That's what they're saying. And it's not a transitory thing. And we're going to have to start raising interest rates. We're going to have to vigilantly raise interest rates. And that, I think, is what has spooked the large cap growth stocks. So watch large cap growth. I mean, are they going to react positively to this yield coming back down? Again, technically they should. Valuations based on rates coming down generally go up, valuations on growth stocks. So we'll see what happens. That'll be an interesting thing to watch today. Let's keep moving on here. I wanted to show you this sector summary. So I wrote a couple articles over the weekend, but this was featured in one of them. I think it might have been in my article yesterday. But anyway, look at the last week's leaders. This was 1 week. I pulled up the S&P sectors, and then for the period went back 1 week. So we had the big move down, the big move back up. And so essentially we finished the week up slightly. So what happened to, what was going on beneath the surface? Well, look at what was going on. I mean, I'm not making any of this up. Healthcare, real estate, and utilities were your three best sectors last week. Makes sense when the market's going down. It does not make sense when the market comes back up and you finish with a net positive on the week. I mean, we had 8 of the 11 sectors were up last week, but the 3 that were the primary leaders, the only 3 over 2%, healthcare, real estate, and utilities. That does not make me feel very good about the market. They got technology there in the middle and communication services. Okay. Look at the bottom though. Consumer discretionary. So once again, staples outperforms discretionary in a week where the market actually went up on a net basis. It's not going to make me feel good. Maybe it makes some other folks feel good. I mean, you can talk about the S&P 500 going back through neckline resistance, which it did. I mean, there's some mixed signals right now with that head and shoulders pattern. I'll be honest. I did not like the volume on the way down. It didn't confirm. It was moderate volume, and maybe at a different time, it would have been pretty heavy volume. But with what we've been experiencing lately, it was just kind of moderate volume. And then the volume on Friday coming back was actually even stronger. Or maybe, no, Thursday reversal. Friday went back down a little bit. But the Thursday reversal, the volume was huge on the way back up. And that closed, I think the S&P closed just below 4,300 on Thursday. And then Friday, we went through 4,300. And if I just go back to an intraday and just show you what happened just today or on Friday, you can see, look what led. Materials, I just showed you these at the beginning of the show. Materials, financials, consumer staples, utilities, healthcare. Down at the bottom, this big, wonderful day we had on Friday. Technology, the worst performing sector. Communication services, second worst, and consumer discretionary, third worst. Those are your 3 aggressive groups. When you're having a really good day in the market and the market's up, these 3 will be leading, not lagging. So yeah, they were all up, but money is rotating into other areas of the market, not into our aggressive areas. And that just tells me Wall Street's positioning for more weakness ahead. Again, no guarantees. It's just, what I'm seeing and the signals that I'm seeing. We'll see whether or not, it helps. Usually it helps to follow what's going on under the surface of the market. All right, S&P 500. So here's the channel that I'm kind of watching. And, I'm not using this as an absolute, it can't go through this resistance or it's not allowed to go through this support. I just find it interesting going back over the last 3 months that if you connect the highs, the main peaks right here, and you drag that line, look at how almost perfectly it connects the lows. So I think it's worthwhile at least keeping an eye on this channel because we are in a downtrend. This channel, we can't go up without this channel breaking. The channel has to break. If we stay in this channel, I can guarantee you, the one time I'll guarantee, if we stay in this channel, we're going below the recent lows. We can't avoid it unless we can break out of this channel. So the first thing the bulls have to do, in my mind, at a very minimum, is get back through 4,500. That was the last reaction high up here near 4,500. There's your trend line coming down, which is at 4,500. The recent highs before that, the double top was up at 4,600. Could we go through 45, get to 46, and then turn back down? Sure. I mean, there's, this stuff isn't guaranteed. It's just giving you, technical analysis for me is just risk management. If I was in stocks and I got back up close to 4,500, I'd be out for sure. Just based on this, it's just telling me the risks are elevated as I get up to the top of this line. It doesn't tell me that there's no way that we could possibly go above the line. Okay, so, you could draw trend lines. The thing is with trend lines, you usually connect a couple of points. The stronger the trend line, usually you'll have more points, more tests along the way. So if we had 10 tests of a downtrend line, then I would be much more interested when we break above it than if we have just, a few. And then I guess, these two are pretty close. When you connect the bottoms, it's just a couple, but it is interesting how they line up the way they do. NASDAQ 100. Here's the NASDAQ 100 channel. Guess what? Same thing. Connect the highs. Even though some days the NASDAQ outperforms the S&P, other days the S&P outperforms the NASDAQ, both are in a pretty, I don't know what the right word is, but, a nice channel here. I mean, if you take the highs, connect those, it's just 2 points. But that slope, if you grab that exact line and drag it down, which is what I did, it essentially, it was just a little off, but it covers, the two lows. So this is the channel. So for the NASDAQ, I'd be watching around 14.5. Right now, 14,189. So we could go up 300 points, 2%, and still be in this down channel. Okay, last thing I wanted to do here on the S&P 500 was just show you the S&P 500 on the top. This is a 15-day, 15-minute chart. So this is one day made up of 15-minute candlesticks. So there's one day, here's one day, here's one day, and so forth. So you go back 15 days. What I have down below, of course, this is S&P on the top. Down below, I've got the consumer discretionary versus consumer staples. So one thing I thought was very interesting is on the rally on Thursday, you can see we rallied on the XLY, XLP, beautiful. But on the rally on Friday, I showed you, and that the consumer discretionary was the laggard. That was the one at the bottom of the chart. And here you can see it, more visually, I guess. We're down. So as the S&P went up, we're seeing money rotate away from consumer discretionary. How about transports versus utilities? This is another ratio that I like to watch. I don't like it as much as the XLY, XLP, but I still like to follow it. And it makes sense to me. I mean, when the market's doing well and the economy is strengthening, transportation stocks should do well if you're shipping more goods, right? Utilities being very defensive, when the market strengthens, they tend to underperform. So this transport utility should give me a pretty good aggressive versus defensive ratio, kind of like the XLY, XLP. And they're similar. I mean, if you look at them, they're pretty similar. Well, guess what? The transports versus utilities closed almost on their low on Friday and trended down much of the day. Even though the S&P was breaking out the new highs at the end of the day, this transport utility ratio was down, rolling over. How about the IWF, IWD? This is the large cap growth versus large cap value. Well, good day on Thursday, like I mentioned. Growth stocks were really in favor. Friday, it's like, nope, just kind of going sideways, not really seeing any strength in growth stocks. And then down here at the bottom, this is the small cap growth versus small cap value. And you see the huge day on Thursday and then kind of rolling back over a little bit, strengthening into the close on Friday, same as the IWF, IWD. We were seeing a little bit of strength into the close. But these are some of the charts I would be watching over the next couple of days. And if the S&P keeps trying to go higher and you're not seeing these ratios confirm it at all to the upside, that to me is just manipulation. And, we're seeing the market rotate and Wall Street moving into a position for the next downtrend. So I would be very careful about the market right now on the long side. And honestly, I'd be careful on the short side as well. I'd be using strength to maybe build short positions, or as I mentioned last week, one of the things that I'll think about doing, I have a little bit right now, the QID, but I would definitely add more if the overall market were to continue moving higher. If we see the S&P get closer to 4,500 and we see the NASDAQ get closer to that 14.5 level, that's going to be where I'm going to be more interested in some of these inverse ETFs. And they're not for everybody. I like them just because rather than trying to pick out individual stocks, because my luck, I'd pick out the stock that goes up, in a down market. So I'd lose on my short while the market's getting hit. So this way, if the market goes down, you make money. If the market goes up, you lose money. It's that simple. So you can decide how much risk you're willing to take, knowing that the market generally doesn't move 10% at a time. A stock very easily could move up 10 or even 20% in a day. The market overall, we can get into some of these volatile days and see these 3 and 4% moves, but generally, 1, 2% is pretty big move. So I just feel like that's one way I can trade the market, not feel like, I'm taking too big a risk, but still trade what I believe, which I think is a market that goes lower. And then, of course, the other thing that I like right now is gold. I've been talking about that. Gold this morning's up about 1.5%, back up above $1,900 an ounce. I think it goes to 2,000 short term. And I'm talking about probably, I think by the end of the month, it'll hit 2,000, maybe higher. I don't know. Or maybe it won't get there. Certainly there's no guarantees. It's based on fear. So if all of a sudden the Fed comes back and says, you know what, we made a mistake. We're not going to raise rates as often as we thought. We're just going to sit back and wait a little bit. I mean, that the market would soar. That would be a real leap to the upside, and one that I believe would be sustainable. That would be huge. I don't think that's going to happen, but that would be one I'd be paying attention to and saying, whoa, okay, maybe I need to get out of any shorts I have. That would bother me. But short of that, I don't, because I see the inflation numbers continuing to be very, very high over the next 2 months at least. And that's going to keep the talk about raising rates and how many times. And I think that's what drives these growth stocks and the overall market lower for the next 60 days, 30 to 60 days. I mean, I think, if I had to guess, I would say we bottom in early April. But maybe it's the latter part of this month. Maybe it drags on a little bit longer. Let's just keep watching the market and see. But that would be my time frame. If I'm right about the market going down, at least one more time, maybe a couple of more drops, but at least one more time. And by the way, if this market gets down below 3,800, I will be looking at some of my favorite stocks and be starting to pick up, even if it's just 10% of it here, 10% of it there, kind of a thing. That's what I'll be looking for at the bottom, to start picking up some of the stocks. I'm talking about stocks like Tesla, Apple. Some of these companies that are really strong, great long-term investments. And there are plenty others out there. Microsoft certainly is one that comes to mind. I like some of the really rapid growers. I believe it or not, anybody who's been listening for me a while will believe it, because I've been talking about it for a while. But I still like Zoom. I think Cathie Wood eventually is going to be right. I don't know if it, how long it takes to go back up. It'll be a while before it ever gets back to its all-time high, but I wouldn't be surprised to see it double in the next year. Once the money, everything returns back toward growth and interest rates, are actually showing signs coming back down. I think that's when growth takes off. And I think a stock like Zoom could easily double, but it's 120 something now, and it might be 65 or 70 before this is all said and done. I have no idea. I thought it was ridiculous when Zoom got down to 300. So here it is at 120, 125. What do I know? We'll just see how low it goes. But I do like these growth stocks. Another one's Datadog. That one hasn't been hit as hard as some of these others, but I like that one. I love Airbnb. There were some companies that have been hit pretty good. Etsy is another one. But those are smaller. They're going to be a little riskier than Apple and even Tesla. Some folks, Tesla, it's like you either love it or you hate it. I'm a big fan of Tesla, and I didn't used to be. I wasn't a big fan of Elon Musk at first. I thought he was a nutcase. Now I just realize he's a brilliant nutcase. All right. That's all I really wanted to show here. We're running out of time, and I don't want to take up too much of your time, but I did want to just point out, you may watch some of these ratios. It's not just about what the market's doing. We get so tied up in the S&P's doing this, the NASDAQ's doing that, the Dow up 600, down 600. It's really about the rotation. That's giving us a bigger clue about the sustainability of whether what you're seeing is something that might last, which I don't know, call me crazy, but I think that's kind of important. Technology relative to the S&P, you can see it's still been trekking lower, but the overall uptrend is undeniable in the long term. And that's because we still have rates that are near historic lows. You know, when we talk about higher interest rates, we're talking about rates coming off of ridiculous lows. I'm not talking about 6, 7, 10%. We're talking about 2%. You know, this was a pipe dream, 10 years ago, getting 10-year treasury yield down to 2%. And here we are worried because it's at 2%. It's all about perspective. Let's just take a look at a few stocks here for the 3 you must see. We'll get a quick update here for you. I'll just take the top 3 Dow stocks today, and that'll be what we look at. Yeah, see, NASDAQ on a relative basis here is actually doing better, and I think that's because the rates are down today. So it wouldn't surprise me to see the NASDAQ outperform today. And if rates go back up, I think you'll see money rotate right back out of the NASDAQ on a relative basis. VIX, by the way, 31 and change. So we're still way up there on the VIX. We'll see what happens. But right now, 31, anything in the 30s, you can expect anything in the market. I mean, it's just crazy. Are they going to give me the Dow? No, I don't have percentages yet. Market just opened. Probably have to wait a little bit. I'll tell you what, I'll just do Apple, Amgen, and AXP, since those are the 3 showing there. Apple, big gap down. I mean, that's now your short-term support. I personally think the market rolls back over and we go back down on Apple to about 140, upper 130s, 140. I think that will be what coincides with the market down to 35 to 3,800 area. And so I just see that's where I believe the market's going. So short-term support, 153, 152 and a half, but longer term or more intermediate term, I should say, probably down around 140. And then I think Apple becomes a really significant buy, assuming that everything else is playing out the way I suspect. I mean, obviously, I'll reserve judgment until we get there. Next up is Amgen. Amgen actually had started to show some pretty nice strength coming off this double bottom here. Nice move with its earnings. It's pulled back. I actually like Amgen. I mean, if I was pinned down and somebody said, you got to buy 5 of the Dow stocks right now, go right now. 1, 2, 3, 4, 5. Which ones? What 5? I think Amgen would probably be in my list because I do like the fact it's in the healthcare area. It's a really long-term, really nice grower. I don't think that they would be impacted as negatively with inflation as many other stocks. So I think Amgen would be one of those stocks. Now, am I in it? No. Am I buying it? No. I'm just saying, on a relative basis to some of the others in the Dow, I would pick Amgen. And then the last one is AXP. Don't own this one either, but I like the way it's been trading. I think we'll probably go back down, test this 180 area, which is where it gapped last Thursday down to. But 180 to 200 is now the current trading range, I would say. And maybe even down to this support, which is where the 50-day is. So maybe we go down to about 177. But let's say 177 to 200, that would be the area I'd watch on American Express. Still, it's trending higher. Money is rotated more toward value stocks away from the growth. And I'd say at this point, the market is looking at American Express as much more of a value play, especially relative to a lot of those heavy, technology plays of really the high flyers and so forth. A lot more on the balance sheet at a company like American Express. Let's go back, take one final look at the market, and we'll wrap this up. Dow down 500, NASDAQ down 92. So still on a relative basis, NASDAQ holding up pretty well. There's your VIX right now, 13%, 31. We'll see what happens. But like I was saying, market could go either way. I think the further it goes up, if it turns positive today and goes up a little bit, I think the riskier and riskier it gets to hold stocks. Watch those relative ratios I was talking about. Unless we can get through and really start to see something that looks sustainable, then I would be very careful just jumping in blindly because CNBC says the S&P 500 is up. Okay, so ignore that. Pay more attention to those beneath the surface signals. All right, I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. If you go over there at 9 a.m. tomorrow morning, 9 a.m. Eastern, and just click on this, you'll get my show. And then of course, I'll be back here at Earnings Beats on Wednesday for our next Trading Places live show here. Anyway, everybody have a great day. Be careful out there. This market's crazy. I have no idea which way it's going to go. We could see the Dow down 1,000. I could see the Dow up 700. I mean, literally, I could see a number of different scenarios on playing out, and it's almost impossible to predict with the VIX in the 30s. I mean, you can, if you're lucky and you catch it on the right side, you make a lot of money if you're in on the long side and it's going up. But if you time it wrong, you chase, and then you get the whipsaw that you see a lot of times in these high VIX environments, it could really get ugly. So anyway, please be careful out there. Have a great day. Happy trading.